Good morning, everybody, and welcome to the British Chamber's webinar in partnership with Bowmans on looking at the big picture, ownership and empowerment regulations in Africa. Thank you so much to Bowmans for joining this morning. I'm going to briefly introduce you now, but Ashley will give a more detailed introduction shortly. We have Ashley Hale, who's Bowmans' co-head of corporate development, Lerato Tahane, head of with mergers and acquisitions, and Nonku Zondo, who's an associate within the mergers and acquisitions team. We're very much looking forward to hearing what you have to say today to what is a critical subject that comes up regularly for us at the British Chamber working across Africa. It's quite an auspicious morning today, not just because of, shall we call it, Z Day yesterday, where Jacob Zuma was convicted, but perhaps more importantly, in a reflection of our morale this morning, is England's historic victory over the Germans last night. So to that end, I'd like to get us all in the spirit of engagement and really looking at an opening icebreaker poll where we can perhaps review which of the following sporting events running is your favorite. The Euros, Wimbledon, we have the Lions kicking off this weekend, we have cricket, none of the above, a different sport please. I don't follow any sports, or all of the above. We're actually having a bevy of sporting feasts at the moment. And while you're responding to that, just a quick reminder of what we're aiming to do here at the Chamber. We are a chamber for the SADC region, the Southern African Development Community. And we work with the DIT and the high commissions and embassies across the region to really focus on three core areas. That first area is around advocacy and policy. So today's topic would fit into that. How can we increase bilateral trade flows from our region into the UK and across the region by making a more business-friendly environment? And this morning I had a call from Uganda and Kenya where there were certain issues where they're saying, Leon, can you help us with the ambassador locally to address some of these issues? The core area where I believe we add value is around the area of growth. Again, mergers and acquisitions is critical to that, understanding the landscape. But as chamber members, we want to help you grow by giving you access to our ecosystem, our network, and our insights that Bowmans are going to share with us this morning. And thirdly, hopefully giving you cutting-edge market intelligence and insights. Will the Lions be touring? Can we have spectators? When will the vaccination arrive? But I tongue-in-cheek, these are critical questions. Do I have to isolate in the UK? How can I actually develop my career more effectively? So we're hoping to kind of really support that ongoing mission across the region. Perhaps we can look at the result of the first poll to see what we're all thinking in terms of, so Euros 32%, Wimbledon closely in second place, followed by the rugby. Not many cricket fans today. My colleague Cecilia is going to very few of us are not into
Thank
sports,
you so much for those who provided questions
most
ahead
of
of
us
this
are
session.
interested.
I do encourage you to use the Q&A button.
So what we're going to do, we're going to have a couple of
so we will
polls
come
this
to you
before we
can.
hand over.
And this
to
session is
Ashley
being
and the team
recorded,
to give us
so
some
we will share it with
insights.
you after.
Then my colleague Cecilia is going to feed in your
questions.
And
thank you so much
before
for
I
those
hand
who
over
provided
to
questions
Ashley,
ahead of this
perhaps we're going
session.
to run two more
I
polls.
do encourage you
And the
to use
first
the
one really
Q&A
is
button,
just to
the
assess
interaction button.
So
So we
our
will
level of
come to you
understanding of this
if we can.
topic.
And this
Can we green light
session
that next
is being
poll, please?
recorded, so we will share it with you afterwards, and we will introduce you to the Bowmans team afterwards.
So before I hand over to
are you
Ashley,
completely
perhaps
green?
we're going to run
Do you
two
have
more polls.
some basic
And
knowledge?
the first one really
Or
is,
do you have a
just
solid
to
background,
assess
or are you in the
our
expert
level of
category?
understanding of this topic.
And that's really going to
Can we
help
green light that
inform our
next poll,
speakers
please?
this morning in terms of where they're going to deep dive and where perhaps not. But I think
So,
it really is interesting. As I
are you
said, this
completely
comes up as a
green?
topic
Do you have
for
some
UK
basic knowledge?
investors across the
Or
region
do you have a
saying,
solid background?
what are these
or are you in
regulations
the
going to mean
expert
for our
category?
market entry?
And
but
that's really
equally
going to
for our
help
growth?
inform our
So I
speakers
think
this morning in
something
terms
that's
of
very important.
where they're going to deep dive and where perhaps not. But I think
Perhaps
it really
we
is
can run those
As
results
I said, this
as
comes
soon
up
as
as a
they
topic
come up.
for UK investors across the region saying, what are these regulations going to mean for our market entry, but equally for our growth? So I think it's
Yeah, and just while we're waiting, I just remind everybody with the new poppy regulations, could you please
perhaps we can
reply
run
to the
those
email in your
results
inbox
as soon as they
so we
come
can
up.
stay communicating with you. Yeah, and just while we're waiting, I just remind everybody with the new poppy regulations, could you please reply to the email in your inbox so we can stay communicating with you. So we have a quarter of us that are completely green, over half have some basic knowledge, and with a fifth, just some solid background knowledge. Few of us in the expert category. Well, that's why Bowmans are here this morning, our resident experts that are going to help us. Again, in this final poll before I hand over to Ashley and the team, if we could just tee that up. Final poll before we hand over. Which trends are you most interested in us unpacking today, in today's presentation? That will just come up on the screen shortly. Sector regulations, local ownership targets and reporting requirements, enforcement through licensing and reporting obligations. I'm particularly interested in that one myself. Upcoming changes to the regulation. I think policy certainty is another big factor in terms of
if I invest now, if I make a merger and acquisition, will that be relevant in 2 years' time? Will the legislation change or something else? And perhaps, Ashley, I can hand over to you while Kurti fires up the presentation, and Ema can feed in those results as and when they come in. So, Ashley, good morning, and thank you again to you and your team for joining us. You're going to talk us through 5 distinct subjects this morning.
Yes, morning, Leon. Thank you for those introductions. So as you've already said, I'm Ashley Hale. I'm co-head of our corporate department at Bowmans. I'm also a practicing attorney in our mergers and acquisitions practice. And my team today, who are talking about the topic alongside me, are Lerato Tahani, who's also a partner in our mergers and acquisitions practice, Nonku Zondo, who is an associate in mergers and acquisitions, and our a fourth team member who's helping drive the slides today is Kurti Moodley, who's a trainee in mergers and acquisitions. So Kurti, if you can just move to our intro slide. So I think firstly, thank you for the opportunity to talk to your members today about what we find a really interesting topic. And it is informed by our research into local ownership and empowerment regulations in 14 Sub-Saharan African jurisdictions. And I think the first point to note before we get into the detail is that there really isn't one size fits all in terms of regulation in this space. Much of the regulation is born out of historic, socio-economic and political factors, but there are certainly some trends that are worth noting, and which is the purpose of today's presentation, to talk to some of these. And these include increased regulation that we're seeing in certain sectors, increased and more stringent targets, and of course reporting requirements, together with enforcement that we're seeing happening more through licensing, investment approval regimes, and reporting obligations. And at the end, we're going to touch on some upcoming changes that we're seeing or are expecting to some of these regulations in the short term. So we've had the second poll, and hopefully as we go through, we are addressing where your interests and concerns lie in this space. But to kick us off on the first topic, I'm going to hand over to Lerato, who's going to talk about increased regulation in certain sectors.
No, thanks, Ashley. Perhaps before we jump to Lerato, we can trigger up the poll results from the second. There we go. So sector regulations, just 3% of us, 41%, which is the majority, local ownership, targets and reporting requirements, then 21% enforcement through licensing and obligations, and 31% upcoming challenges. Now, I'm sure we'll address those topics. And again, I encourage you to use the Q&A function, and Cecilia will feed in your questions. Thanks, Ashley. Thank you, Lerato.
Thank you very much, Leon. So going into this project with Ashley and Nonku, one of the topics which I was most interested in was sector regulation and how this differed from country to country. So it's no mistake that I'm covering at least what I think is a very interesting topic and an observation which emerged from our analysis. And just to drill into the detail of what I'll cover, I'll be talking to certain sectors which were previously unregulated that are now subject to regulation in a number of jurisdictions. Just to briefly set the scene, typically the regulation of foreign participation in local companies across a number of African countries tended to be limited to what we call big ticket sectors, such as aviation, logistics, mining, financial services, oil and gas, broadcasting, and telco. Some of you operate in some of these sectors, so you'll be very well aware of the prevailing regulations that exist in the sectors across the various jurisdictions in which you operate. And you will also be very well aware that some of these regulations have been in place for some time. Recently, however, we've noticed a slight shift and a trend towards increased regulation in sectors that were previously regulated or that were previously not regulated. And what we've noticed is this trend appears to be spreading. I'd like to run through a couple of examples before sharing our insights with you. So in South Africa, for example, private security is now a sector focus for local ownership regulation, when previously it wasn't really a focus area for our government. Since June last year, Botswana reserves various activities such as bread and confectionery baking, car wash businesses, takeaway food outlets, meat processing, water bottling, school uniform manufacturing for citizens and for local companies. Ghana, as another example, very recently reserves certain activities for local ownership, including taxi services, car hire operations, manufacturing of basic stationery, and pharmaceutical retail sales. Nigeria, which we all know is one of the more protectionist economies in Africa, historically has not really regulated economic activities such as advertising and architecture. And now they're starting to focus on these sectors more and more. Furthermore, countries such as Kenya and Malawi, which tended to have a light touch regulation on ownership and empowerment, are starting to up their regulations. For many of you on this webinar, some of these newly regulated sectors won't be sectors that you operate in. But the reason we wanted to share this trend with you is that it indicates a shift from the more traditional approach to local ownership regulation. And our sense is that this trend may continue to evolve and will come to impact more and more sectors over time. So we're very interested in keeping an eye on what happens in this space. Now, a question that comes up very often is why? Why are more and more regulators looking to regulate the ownership and management of some of these kinds of sectors? Or rather the ownership and management of companies which operate in some of these sectors. Our observations suggest three drivers. The first is they're probably looking to stimulate the growth of small, medium, and micro enterprises. Secondly, regulators across the continent are probably looking to encourage employment through the types of employment opportunities that are created in these kinds of sectors. Lastly, they're probably looking to protect certain sectors of key national strategic importance. For example, the private security sector, which, as you'll be well aware, is a global trend and not just something that we're seeing on the continent. Another observation is that generally, some of these so-called big ticket sectors, which were traditionally the subject of empowerment regulation, have higher barriers to entry. Some of these barriers include high setup and entry costs. Operating in some of these sectors generally requires very sophisticated technical skills and abilities. And lastly, some of these sectors tend to be in the context of highly regulated frameworks and complex licensing regimes, which tends to exclude citizens and local companies from thriving in those sectors. Shifting the focus to sectors which can, for example, employ a more broad base of people has its advantages, and some of the regulators are seeing this. We received a number of questions and comments ahead of this webinar, and thank you very much for sharing these. We've really enjoyed engaging with some of the content. And a number of the comments centered around whether we believe that these restrictions and regulations act as barriers to economic growth on the continent. And our view is that they do not necessarily constrain economic growth. As always, a delicate balancing act is required between stimulating local growth through foreign investment on the one hand, and facilitating inclusive participation by local citizens in the economy on the other hand. Now, this balancing act must be found in order to avoid potential unintended consequences of constrained economic growth. And it needs to be addressed, right, in both the big ticket sectors, which have traditionally been regulated, as well as these bread and butter industries, which are now becoming the subject of more and more regulation. Now, while some of the regulations are complex, they're not insurmountable, right? And with the right understanding of how some of these frameworks work, and with the right legal advice, we believe that investors can navigate the complexities, and they can actively participate and do work in some of these regions without too many hurdles. Now, I know I've spent quite some time talking about some of these bread and butter industries, which are coming into the focus of a number of regulators. But it would be remiss of me not to point out that there's still quite a lot of activity and quite a lot of regulation in the more big ticket sectors, such as telco, mining, technology, financial services, and renewable energy, sectors which we know a number of you operate in. So I'll hand over now to Ashley, who will touch on some of these in her next section. Over to you, Ash.
Thank you, Lerato, for contextualizing the comments that you've made. Essentially, the increase, as we are seeing it in some sectors, of ownership targets are really around these big ticket sectors, the growth sectors, essentially, on the continent. And I just want to run through a few examples because some of them are quite interesting and fairly recent in terms of the regulation that's been passed. So Lerato has mentioned private security. Again, a recent development in Nigeria is an absolute blanket ban on foreign ownership. I mean, this is an extreme example. We see in Kenya, the limit has been set at 25% local ownership. Again, a fairly recent development. South Africa has had on the card, some of you may have been aware of it for quite some time, a proposal to put in place a local ownership of at least 51%. That draft legislation is still not law, and we wait to see what happens in this space. Telecommunications, there's a lot happening, telecommunications and broadcasting. It is a growth sector. A recent development in Uganda is that there's now a requirement that at least 20% of shares in licensed telco operators are to be listed on the Ugandan Stock Exchange within 2 years. Nigeria, again, quite a high target has been set in broadcasting services, at least 70% to be locally owned. And some of you will be aware in the South African context of the recently published ICASA regulations, where licensees in telecommunications are to have at least 30% BEE ownership. And forgive the mistake on the slide, it's within 3 years of the publication earlier this year of those regulations. So there's a transitional period to achieve that level. And coupled with that is a requirement to also maintain a level 4 BEE status as a condition of the licenses. Mining, again, mining, oil and gas, big ticket sector, a growth sector in many economies. Here, what we see linked, I think, to Lerato's comments in respect of perhaps smaller scale type sectors, we see in mining, small scale artisanal mining, totally reserved for citizen ownership in Ghana, Malawi, and Zambia. Interestingly, Kenya has just put in place a new mining act where essentially every license that's issued is conditional on local equity of at least 35% being obtained, and 20% of that to be listed on the Kenyan Stock Exchange within 3 years of commencement of production. Financial services has also seen quite an uptick in the level of targets being set. Zambia, actually, the slides note that it's a proposal. In fact, the legislation was passed a few weeks back that in respect of insurance and insurance brokers, For brokers, 51% to be held by local citizens, and for insurers, it's at a 30% level for local ownership. These are very similar to what we see in Kenya as well. In fact, it's slightly higher, 60% local ownership for insurance brokers, pension fund administrators, and 33% in respect of insurers, but it can be citizens from the East African community, not just from Kenya. South Africa, there's a renewed focus in the sector to try and ensure that the targets that have been set in the Financial Sector Code are actually being met, and a proposal possibly to have increased oversight in this sector by the Financial Sector Conduct Authority. The other point I just want to note here, as some of you will be aware, that the competition legislation, and this applies in South Africa in particular, but Botswana and Namibia, is that the authorities are empowered through the competition legislation to consider as a public interest factor the local ownership levels of firms involved in mergers, in merger activity. And it's quite common for particular conditions to be applied as part of a merger approval, which could include putting in place local ownership structures, particularly through, for example, share ownership schemes, worker share ownership schemes, up to a certain percentage within a period of time. So, and this is a trend I think that's increasing, and our minister has recently spoken about this being quite an important aspect of increasing, for example, worker participation. I'm going to now move to the next slide. And back to Lorata, who will talk to us now about the reporting requirements and the trends we're noticing in this regard.
Thank you very much, Ashley. So to unpack some of the trends that we've noticed in relation to reporting obligations, unlike what we've seen in the last few years, where in a number of jurisdictions, companies would have to report on their performance against local ownership targets at key milestones. So for example, when they're looking to implement a fundamental transaction, or if a regulator performed an inspection and asked questions. More and more regulators are now requiring greater transparency through annual reporting. I'll touch on this in the South African context in relation to our BEE framework and the active work of the BEE Commission. I'll touch on this in the Ethiopian context in relation to their investment framework, and also in Nigeria in respect of its more sector-specific approach to annual reporting obligations. So in South Africa, where BEE applies, the BEE Commission has been established to oversee, supervise, and promote compliance with the BEE Act, to receive complaints relating to BEE, to investigate any matter concerning BEE, including alleged fronting practices, and referring them for prosecution, and to maintain a registry of all major BEE transactions. In furthering the work of the BEE Commission, all JSE-listed companies in South Africa are required to submit an annual compliance report to the BEE Commission on its compliance with the BEE Act, if any. They're now required to load this annual compliance report on its website and to publish a SENS announcement confirming that the annual compliance report is available on the website. Another development on the reporting front is all parties to a major BEE transaction over the prescribed transaction threshold of 25 million rand are obliged to submit that transaction to the BEE Commission for registration. In addition, in the South African context, a number of other bodies monitor and enforce ownership compliance. And these are bodies such as ICASA in the telco licensing space, as mentioned already by Ashley, the DMRE in the mining licensing space, and of course the Competition Commission, also as mentioned by Ashley. Traveling up north to Ethiopia, certain regulatory changes have recently been introduced, which now require annual reporting. And in some respects, certain companies have to report on a quarterly basis. So, for example, all investors are required to submit a quarterly progress report on the implementation of their investment projects in Ethiopia. And some of the pillars of these reports speak to issues of localization, ownership, management by designated groups. And in Nigeria, sector-specific annual reports must be submitted to bodies that are established to look after those particular sectors. So, for example, each oil and gas operator in Nigeria must submit within 60 days of the beginning of each financial year its performance report. And what this report will generally cover is how that company is performing against its project targets as regards employment of citizens of Nigeria, procurement requirements in relation to local companies, and generally how it's doing against localization requirements and targets that are set when a particular investment project is initiated. Now, the trend that we're seeing in the jurisdictions that I've mentioned and a couple of others is a shift towards more reporting and a shift towards greater transparency. For the most part, we believe that regulators are identifying the benefits of increased reporting in helping them to better understand, one, what's going on the ground, and secondly, to help them identify where there's a need for policy change or legislative amendments. Another benefit is the data that's reported on an annual basis, and as I've mentioned in some respects, quarterly basis, provides a valuable basis for monitoring and managing compliance. And on this note, I wish to hand over to Ashley again, who will take us through some of our observations as regards changes to enforcement, particularly in the South African context.
Thanks, Lerato. So just as an opening comment, the regulations that we see in these various jurisdictions do tend to come with quite severe financial penalties and sometimes criminal sanction for non-compliance. So that they are quite severe in most instances. However, what we see is that you don't often encounter criminal prosecution or fines necessarily. And I think that's because of the manner in which the enforcement tends to take place. There's a couple of reasons for this. In the South African context, you'll of course be quite familiar with the rating system that happens under the BEE regulations. It's a requirement in order to reflect what your BEE status is, which includes ownership, is to obtain a rating from a verified rating agency. And the focus, and it's specified in the regulations themselves, the focus in getting these ratings is, of course, to ensure there's substantive compliance and genuine empowerment. In fact, it's a principle in the codes themselves that substance applies over legal form. And one of the tasks of accredited rating agencies is to dig down, I think, into the legal documentation to ensure that the empowerment is actually and local ownership is actually genuine. So that really is an important part of ensuring compliance by companies in South Africa. Lerato has touched on already the increased reporting requirements to the BEE Commission. Of course, the BEE Commission is also mandated to initiate investigations, either through complaints or through on its own initiative. And this has had an impact in ensuring that there is better and more focused attention given to compliance with the regulations. In addition, we've touched on the Competition Commission and the Competition Tribunal. The oversight here that we are seeing more of is attention being paid in merger filings that are submitted for approval, to look quite carefully at the local ownership level and the impact a merger will have on that. Some of you will be aware of the recent Burger King decision where that merger was prohibited, essentially based on the fact that the exit or the sale by the BEE shareholder to the acquiring firm is going to result in zero BEE ownership resulting from the merger. And that was one of the reasons. I mean, there's a number of reasons, and it's in the public domain. But that was one of the main reasons why that merger has been prohibited. Outside of South Africa and looking further afield, what we see, the enforcement regime tends to happen in sectors where there are licenses required in order to operate. So in the telco, the mining space, for example, financial services. You'll often find that those licenses contain conditions around local ownership and local participation in the venture. And of course, non-compliance with that raises the threat of losing that license. In some countries, such as Ethiopia and Nigeria, it is a requirement for a foreign investor to actually obtain an investment license. So even if it's not necessarily in a sector that requires a license to operate, the foreign investment approval tends to contain the particular local ownership condition. And it's through these means and mechanisms that the enforcement is considered and takes effect. So that's just a brief overview of those trends as we're seeing them. The last section, we're going to hand over to Nonku to deal with some upcoming changes in the space that we are.
Thank you, Ashley. Based on our research, the upcoming changes and some of the more recent changes that have been put into effect in some of these jurisdictions tend to follow the pattern of the key drivers that Lerato mentioned earlier. And just to reiterate, these key drivers include the protection and reservation of certain industries for locals, over and above sort of the bread and butter industries that are typically reserved. There's a move towards reserving those national strategic interests and those assets that might have implications for national security. Secondly, another driver for some of these changes is broadening the base of beneficiaries and broadening the reach of those empowerment provisions so that the empowerment reaches a larger number of people than the traditional model of local ownership and empowerment regulation that we've seen in the past. And finally, some of these changes are also driven by the need to present each country as being open to business, and particularly in the context of COVID-19 and some of the challenges around economic recovery. We're seeing the BEE space and the local empowerment space as a space in which some interventions may be made to accommodate some of those economic recovery intentions. One such example is Ethiopia. And as part of their efforts to stimulate foreign direct investments, they've made some changes to their investment proclamations and the general investment framework. And the ultimate result of that framework is the creation of 4 tiers of investment and the reservation of certain sectors for 4 groups of people. We're seeing that there are certain sectors that are reserved strictly for Ethiopian nationals. And these are predominantly in the financial services sector, micro-lending, insurance, as well as media and the distribution of electricity. After these exclusive areas, there are 3 more areas of sector reservation, and those cover sectors that are exclusively reserved for government participation only, and then the remaining sectors that are open to joint ventures either with the government or other Ethiopian locals. By contrast, and in the same vein, Zimbabwe has currently proposed changes as well to their indigenization and empowerment structure and framework. And among these changes, there is a decrease, in fact, of some of a proposed decrease of some of the current requirements. Under the existing act, we understand that the ownership levels are set at a 51-49 split, where 51% of the ownership in certain businesses in Zimbabwe needs to be reserved for locals. But we're seeing with the upcoming changes or the proposed changes that this might be done away with. Previous iterations of the indigenization bill included continuing with the 51% ownership strategy in the platinum and diamond sectors. However, we're seeing that there's discussion around this aspect falling away as well for those key industries, so as to stimulate additional investment. In South Africa, some of the changes are a little bit more protectionist, and this is highlighted in the private security changes that Ashley and Lerato have previously mentioned, with a change around the 51% ownership in the private security industry. And then finally, from a competition perspective in South Africa, we're also seeing greater concern from the Competition Commission around the foreign acquisition of assets that are deemed to be of national security interest. One of the amendments to the Competition Act include the creation of an executive body that will be assessing foreign investments or foreign acquisition of national security assets, and in that sitting, separate from their merger control approvals, and in that sitting they'll be considering the impact of such foreign acquisition of national security assets, and how that may adversely affect the country's national security. We've also seen changes in Namibia in the new equitable empowerment framework, economic empowerment framework. Among some of the changes that are proposed in that Namibian bill is a 50% management control being reserved for Namibian locals. There's also restrictions around land ownership by foreign investors, and there's also talk of restriction of ownership to 25%. However, we understand from some of our colleagues in Namibia that this 25% ownership reservation is still being considered. In all, I think we're seeing more robust engagement in some of these jurisdictions and in respect of some of these changes. And we look forward to seeing what reforms look like in the context of a post-COVID-19 world, and how that plays out in the regulatory space around local empowerment and ownership. Thank you.
Thank you, Nonku, and really good to look ahead to a post-COVID context, which the rest of the world seems to be accelerating towards, whereas South Africa has been a little bit sluggish and lethargic. I'm going to invite my colleague Cecilia to feed in some of the questions from the audience now. But before I do that, just reaching out to the audience again. And again, thank you to all our speakers for those insights, a really great detail and a really good overview. But perhaps the audience can start thinking about what insights from today's discussion have you gained and what actions might you take? And please feel free to put that in the comments. But I do know there's been quite a few questions ahead of this, Cecilia.
Yeah, I think combined with some things that we've mulled over and just looking at everything that we've seen, I think we've spoken to quite a few of those questions already in your presentation. Thank you very much for that, guys. I think a question, particularly since we do have quite a few foreign-owned companies with operations in South Africa, something that's really front of mind for them, particularly as some companies are asking the question, should they expand, should they not, is what is the viability of their investment coming from a foreign-owned company perspective. That's the case that they would have to go and make on foreign shores. What is the viability? What certainty? Is it worth it? So I think just to have your opinions on that in terms of what is the case that they should be making. And then we've had some questions, of course, on what the targets are and the reporting requirements, which you've also spoken to. I think particularly maybe the targets in financial services, especially, is also where a lot of our members operate in. But I'll stop it right there. If you can maybe share some of your thoughts on just those aspects for foreign-owned companies.
I can maybe just start as a general point to note from a South African perspective. BEE regulation is done on a target basis. So it's not a mandatory requirement to meet and achieve the targets. So certainly, and just a reminder to the participants as well, you're probably aware that ownership is only one of 5 aspects of BEE that's measured. So certainly, from a viability perspective, investment is doable, achievable, and we see with our clients that they have implemented and instituted ownership transactions and addressed the other elements of BEE quite successfully over the years. I guess it is a complex set of regulations, and it is sector specific. So of course, guidance needs to be taken as to what the best approach or strategy is. I mean, I think once those questions have been considered and answered and a strategy adopted, I think the viability is certainly doable and achievable. And it's not, and as you've seen from our presentation, it's not a South African specific thing. It is applicable across our continent. But it is a case of trying to get a better understanding of what the requirements are in order to adopt the strategy that's going to work for your business.
And also, Ashley, if I can add something, we've had another company saying that they're increasingly also having to work with international funders. So also, I think it's the same argument. How do we talk to funders about these types of things? And I think what you've said is possibly really valuable advice on that as well. It's not always about the ownership part, and I think people might tend to forget that from time to time. We've also had questions from 2 different people in the infrastructure and construction industry who would like to know what the impact is of these new developments on SA's infrastructure, and particularly including the increased private sector participation in financing and delivery of what is essentially public infrastructure. How are new regulations possibly going to affect that industry in particular?
Loretta, are you happy for me to jump in? Please add if I...
Sure, very happy for you to take this one, Ash.
Okay, sure. So in the infrastructure space, I guess to the extent we're talking about public-private partnerships in the infrastructure space, the requirements, the economic development requirements are really part of the conditions that are applicable when when bidding to participate in these contracts. And local ownership is only one aspect, or BEE ownership is only one aspect, again, similar to the BEE rules, although in the infrastructure space, the BEE rules inform some of these conditions in the programs, but they're different and they need to be considered and looked at differently. And they're very clearly spelled out in each of the programs that have been launched, renewable energy, for example, programs. The conditions are in there. I guess on the local ownership side of the conditions, what we are seeing based on trends since earlier programs to the current one is that there is more of a focus on Black, female and community participation in the ownership structures. And and perhaps a trend of a slight decrease overall. If I recall, in earlier programs, it was as high as 40%. I think it's about 37% or so in the latest round.
Thank you for that, Ashley. I'm also seeing a comment from Johan, the brain of task, which actually also speaks to something I wanted to mention. On the 3rd of June, the BBBE Commissioner Zodwa Ntuli gave an update on where things stand, and the report is set to be released very soon, if it's not possibly out already. Two of the key issues that she mentioned particularly was a challenge in finding the right BEE partners. And I think that's what Johan is also speaking to when he says it's extremely difficult to achieve longevity in local BEE ownership in the SME space particularly. People's needs change, as we know they do. And once these partners exit, you're back to square one. So I think that is a challenge, and possibly from your perspective, when it comes to BEE partnerships, what do you see? Do you see a lot of deals going south, not working out, or a lot of new ones coming through? And particularly if you look at the SME space, what are you guys seeing?
Ashley, if I may jump in, I'm happy for you and Nonku to add. I think we've seen a number of successful BEE structures in this space. A lot of sort of employee share schemes, which have seen longevity, right? And over time, in some respects, unlocked value for employees. We've seen some successful broad-based schemes and community structures which have also benefited sort of broader communities and certain charitable trusts set up, and a number of BEE structures that have involved strategic BEE shareholders, which have sustained over time. That's not to say that there haven't been challenges, right? And that's not to say that people aren't struggling to find the right BEE partner and to put in place a structure that can withstand the test of time, so to say. But in our experience, we've advised on and seen a number of structures that have been around for many, many years and are doing well.
I think that's an interesting thing, because when I read Johan's comment here, it occurred to me as well, even if you now have some of your employees take part in these things, we all know people leave jobs at a higher frequency than ever before in history. That's just the way the market is. So if you've now created a system, built it in and thought you were great, 6 months later, someone decides, I've got a better job offer somewhere else. And you would have hoped that one might be something that encourages or incentivizes someone to stay within a business, but is it enough? Does it these days? And I think these are, if it's a bigger company, I can see how it's possibly less of an issue, but for SMEs, I can see how the challenge is quite big. And then you possibly have to look at, well, do we get outside partners to come into the business? Are they likely to give us more longevity, or also not? So it is a challenging discussion, I think, to have.
Can I just add a couple of comments or observations? I think we've gratefully had some clarity in Minister Patel's recent practice note, which deals specifically with community trusts and employee share ownership schemes. So I think the rules and how the codes have been set out are now a lot clearer. So that has been helpful. And as Lerato says, there are a number of successful employee schemes and community schemes that have been in place for a long, long time. I do think as well, as a general comment through our experience, I mean, the BEE has been around for a long time, since in fact, before the BEE Act in 2003, the policy that was issued then, it was in the late 1990s. There's definitely been a maturing of the market, and there are a lot more mature Black-owned businesses that invest on a part of ownership structures and are in the market. If a BEE partner does exit at a point in time, there is the possibility for another to replace the exiting partner. I do understand the challenges. It's not the easiest to change your ownership structures. These things take time, and in our experience, often the ones that are put in place, I guess, too quickly or without enough homework being done in respect of its pros and cons, there can be issues. So certainly doing your homework and putting the extra time and effort does pay dividends for longevity.
I think just an observation from my side, and I'll come back to Cecilia, and I think just speaking as the voice of our members and from my own personal experience, I've been in the country 9 years and navigated 2 or 3 BEE deals, which were very expensive, very onerous. And I do believe had limited impact on the economic upliftment of the people I involved, but it enabled us to be competitive. And I'm not going to put you on the spot to give your views, because it is the landscape and we need to deal with it and address it. And that is what the Chamber and Bowmans are here to do. But I think just to flag some of the frustrations around it, has become a real barrier to foreign direct investment, which would lead to upliftment in the economy, create more jobs, skills transfer. But for small and medium-sized entrepreneurs, as I was coming here as a British man, I've paid a lot of white-owned law firms lots of money to put structures together that enabled us to remain competitive. But again, I would have perhaps rather spent that money into scholarship funds or bursary funds. And that's deliberately kind of controversial, because I do want to be a frank voice of our members in terms of, I welcome you to comment on that and observations, but equally I won't hold you to it. And if not, perhaps I can go back to Cecilia. I can see Nonku body language suggesting you might want to say something to that, and I'm open to be challenged. Yeah.
Lerato, Ashley, please feel free to jump in. I have to put a few disclaimers.
Yeah.
I think the challenge in respect of ownership in this case is that it's deeply political as well. And
yeah.
so I think those have to be navigated with a lot of sensitivity and a lot of nuance. And, some of that plays out in the deal room, in the negotiations as well. And so, even with these changes that we're seeing, it's really about broadening the reach. And I think, regulators are starting to come to the party to realize that the existing, structures that we have aren't translating into broader development for historically disadvantaged persons, however that term is defined in the relevant jurisdictions. And so I think, regulators are coming to the party. I think the conversation is there, and I think it requires, input from all stakeholders in this regard, on how we can make that work and how we can still keep doing business in Africa profitable and commercial, so that we all, in some respect, end up winning.
Leon, if I can comment as well, again, it comes to the point around ownership being one aspect, and I hear you that it's complicated, expensive, and can be inefficient in actually furthering the objectives behind the regulations. But there has been a recent initiative, the Youth Employment Service Initiative, which is a really good initiative, and I acknowledge it does take time to sort of register and get the process up and running. But it's really about absorbing youth into the corporates and getting them employed. Obviously, our country faces a massive unemployment problem, and particularly exacerbated by the pandemic and affecting youth. And that initiative, to the extent that the targets can be met, and they're not insurmountable targets, they do enable a corporate to actually get quite good bonus points and go up potentially a level or two on their scorecard. And I've engaged with clients on this, and it is possible to even look at if your work is a business that can absorb youth as part of this program, you can really sort of, the ownership piece becomes less important. And if you focus on this, you can get to a level, it's a really decent level 4, for example. And you're good, you're addressing the economic imperatives that we need to.
Perhaps before I come to Lerato, I'm really glad you mentioned the Yes Initiative, something that I've tried to get involved with Tasha Ismail since it was set up. And again, the brainchild of my colleague on screen, Cecilia, is something around the Youth Chamber, which we're going to be launching in terms of really partnering with corporates around work readiness, so that they can enter the workforce and the corporate space and actually from day one hit the ground running, and the learning curve increases, because we all know there's being previously disadvantaged isn't just economic, it's understanding how to navigate the workspace and grow within it. So that's something we're really looking at. And what really did kind of give me cause for optimism was I was involved in the CEO initiative a couple of years back with the likes of Mike Brown and Colin Coleman, and really looking at, I sit here and I realize corporate South Africa often gets a bad name, but I see lots of people around the boardroom table really wanting to solve this youth employment issue, this skills issue. And the BE legislation can be cumbersome for the right reasons, not addressing those specific needs that we see. You know, we don't want a society, and this is really what the Chamber is all about. How do we create sustainable economics? We don't want to grow just our shareholders. We want to grow our society. And here I really believe in kind of corporate activism, business for good. And I believe there's a real appetite to do that. So it is frustrating when there's clunky legislation that inhibits that. But I do agree that Yes Initiative is something to address that. With Cecilia, we're going to be launching our youth chamber in the next couple of months, which is really around addressing, getting people work ready into the workforce, because I do believe corporate South Africa wants to step in and play its part. There is this classic quote around ownership is key to intergenerational wealth. And that's where a lot of this emotive political stuff comes into it. But before we get there, we need to ensure that we have our youth gainfully employed and active participants in society. Sorry, Lorata, perhaps we can come to you and I'll go back to Cecilia, just comments on that.
Actually, the Yes Foundation is something that I wanted to mention, but also, you know, a number of structures that we've seen have been really innovative in how they put in place, right? For example, firms that have set up scholarship funds which hold directly into you know, into sort of a BE structure where the beneficiaries are the beneficiaries under the scholarship fund. And they've done a great job at unlocking value, which goes directly to paying, you know, tuition and school fees for learners. And if you look at the success story for some of these companies, you know, it's youth getting educated and getting set up for gainful employment in corporate South Africa. And those success stories are there, right? And there aren't enough. But there are models that we've seen that have worked really well in getting youth participation and getting kids educated. And I just wanted to make the point that, you know, some of these are quite inspiring in how they've been put together.
That's really good to hear.
Thanks. I think on that note also, Amanda Wild, I think would like to have just a few comments on employee ownership models. Amanda, I'm gonna allow you to speak. Should be coming on now. Hi.
Thanks, Cecilia. Happy. Are we Tuesday or Wednesday? I've lost track.
It's Wednesday.
The year's already flying by. Yes, and I apologise because it was a few minutes before I joined, but I mean, Cecilia and Leon, you know the work that we've been doing for the past years in terms of employee ownership. And just to give you a bit of background, Nonku and Lorato, our business is wound care. So we actually look after the wounds of the nation physically, if that makes sense. And when we set up the business, I moved down from UK. You can't miss the fact that South Africa is a wounded nation in so many more ways than physical. So when you're coming at something like triple BEE, I think in the same way we say, look at the whole of the patient and not the whole in the patient, it's important to look at the notion of transformation as well. So what we did very, very early on was we looked for business models specifically that had been originally designed to achieve outcomes in the remit of equality, fairness, and reconciliation. Because these are the principles. Yes, triple BE has been effectively reduced to a scorecard, but if you bring it back to its originating principles, what was hoped to be achieved was more equality, more fairness, and a decent attempt at reconciliation that we did not achieve during the TRC, basically. So what you are left with is unresolved trauma, a huge amount of inequality, a huge amount of unfairness, particularly for certain groups in South Africa, distinctly more than other groups. And you can't simply walk away from it. But what it inspired us to do was look around the world and say, where has a business tried to solve this before? And we found John Lewis's partnership model in the UK, which was set up more than 100 years ago to achieve reconciliation in social classes. And it was only in 2014 that the British legal system caught up and actually created the formal structure for surrounding John Lewis's partnership model. But it effectively requires that the ownership, the ordinary shareholding, is in irrevocable trust for the employees, and the trust is mandated to treat the employees as if they were actually owners of the business, which means you don't just get the benefits of shares and a profit share, you get the responsibilities of ownership, which are that you are now responsible for running the business at the end of the day. That if you want the benefits of ownership, surely you should have the responsibilities of ownership, which means that every employee in that business has a specific role that the business can't be without, because there's no window dressing, there's no possibility of fronting, because you are all owners of the business. It is your group responsibility as well as your individual responsibility to make a success of that business so that it can be sustainable, stay on its feet, create more jobs for people, put better things in the lives of the children of the employees. So I think although we could very much see what the original tenets of BBBE had been, we were left wanting in terms of what is the way to actually do this, which was what drove us off to actually say that we wanted to specifically find a business model that had sought to particularly achieve reconciliation, because it's something that South Africa has never really grabbed by the collar and actually come to terms with. In terms of how do you say sorry to a group of people that you have fundamentally disadvantaged and make right that sorry and put together a structure that actually doesn't just tick boxes but makes a fundamental difference in moving a group of people that had everything taken away from them to a place where they actually are on a fair footing with everybody else. And that's why we did it. So in 10 years, we've never claimed a single BBBE point. And although we've had an 80% public health business, and we're just about to complete our formalization into the John Lewis structure. However, we do not have trust law in South Africa, and we do not have tax law in South Africa that mirrors that of the 2014 Finance Act. In the UK, if that makes sense. So we're having to create a structure called the aspirant John Lewis Partnership Trust model to make it clear to everybody what do we want to be and how do we want to be until the legislative system catches up. So it's, I think, also about having that space within South Africa as well, where we can say who's done it really well elsewhere in the world, and how can we create space within the legal system, the tax structure, the business system to adopt innovative business models, even if it's under the wing of Treasury, under the wing of SARS, under the wing of DTI, to give them a trial run and see if they would be better at achieving objectives that we want to achieve for transformation than a tick box system. Am I making sense? Because all we see in the health sector is loopholes. All we see is companies, multinationals, taking advantage. We had a global multinational the other day, literally submitting a sworn affidavit for a micro enterprise, you know, because they'd only just started trading. Literally, and you're not a micro enterprise, you've inherited a multi-million rand business. But why do we have to live in this loophole system? Why can't we? And I think it's called the spirit of the law, that if we've got the letter of the law and we've got the spirit of the law, that if we could get the spirit nailed down, it would be easier to apply the letter rather than a tick box scenario.
Yeah, good. Thanks, Amanda.
Thank you. Sorry for harping on.
Not at all. Thanks.
If I could briefly respond. So I did touch on the substance over form principle. You're absolutely right. Unfortunately, it's a bit of a balancing act because there is a tick box system to an extent, because there are targets and measures in quite a complex scorecard system. But certainly substance over form is the principle and the guiding principle. I think as well to note that, and I think I touched on it during the presentation, is that Minister Patel has also come out very strongly in favor of worker participation. And there are a number of policy documents that are out in the public domain around this, Amanda, to your point. And certainly we expect to see some legislative changes where the law kind of catches up. Worker participation on boards, for example. I've already mentioned the employee share ownership schemes are a particularly favored mechanism of ownership. And so we anticipate, hopefully, a lot more of it in the light that you describe in that model.
Thanks. Any final questions from the audience, Cecilia?
I think we've basically covered most of the questions, if not in the presentation, but also in the ones that we've had live here now. We've had some questions about also what other countries are doing in your presentation. I think beautifully put all of that in perspective, looking at Uganda, Kenya, all of those, which I found quite insightful. We did have a question from Stephen Gamble, specifically asking about the panel's view on Zimbabwe's program, and if there are any lessons to be learned for us from that. Maybe end with that question before concluding remarks. Oh, and also I see in the chat a question around which country you mentioned requires an investment license on that topic.
Just on the, Lerato, I'll just quickly touch on Zimbabwe. Nonku had mentioned that there has been a pulling back, actually a repeal of most of their indigenization legislation. It only remains primarily in diamonds and platinum. And even there, there is talk that that will be removed. The reason I think for that is obviously a real need to try and to get additional investment, foreign direct investment. And unfortunately, I don't think that's really had the impact they hoped. And I think primarily the reason for that is the difficulties with the exchange control regulations. That's really caused, having the most major impact on foreign direct investment. And of course, being able to take money out of the country is very, very difficult. So that's just my comment on Zimbabwe, and I'll leave Lerato or Nonko to deal with the other point.
There's my unmute button. Just on the investment license piece, I think I'd mentioned it in the context of Ethiopia. I know that other jurisdictions have that concept too. I think Uganda is another one that comes to mind from the work that we did in putting the guide together.
Nigeria as well.
Yeah.
Mozambique, yeah.
Mm.
I think just a final question from Tabang Cladi just came in. What current legislative changes do we need in South Africa to enable utilizing sovereign wealth fund models to address socio-economic transformation, which could also reduce the uncertainty of ownership risk? Any last comments on that?
May I jump in?
Please go for it.
I think from a sovereign wealth fund perspective, a lot of groundwork will have to be done from a governance point of view. We would have to create systems and the bulk of the legislation before even the formation of the fund would have to center around governance mechanisms to ensure that the money meets the objectives that it's been put aside for. And then I think we'd also have to have an administration that is able to work through some of the challenges that come with managing the kind of wealth that is typically involved in sovereign wealth funds. Still a long way from sovereign wealth funds being a viable alternative, just because of the framework that we'd have to establish just to make the sovereign wealth fund, take off and be successful.
Okay. Well, thanks everybody. I think it's just a few concluding comments from me, but firstly, really like to thank Bowmans for your great insights, your levels of engagement. So Ashley, Rato, Nonku, thank you so much. We will put you in touch with them should you need to, and I encourage you to do so. They've been great partners with the Chamber, and we will share the content of this video with you as soon as possible. Just as I'm hearing the landscape which we're navigating, I think it's really important to remind ourselves of why we do this. And I think we all agree, and from the comments and the questions, we all believe in the power of business to do good. And I think the spirit of a lot of this legislation is right. You know, the reason for this legislation is right. It's just sometimes the clunky implementation. So that's why hopefully partnering with people like Bowmans and ourselves, we can encourage investment and create those jobs and solve some of these societal issues. And I think it's really important to remind ourselves when the world is in a bit of a fog, particularly from a South African context at the moment. You know, we have our ex-president being arrested. We have our vaccination rollout on a go slow. We're stuck at home with our children. We're worried about our future, business future. And actually, we do need to have a sense of positivity and optimism, and also agency to say we have power over some of these things. And I think there are some startling statistics we can look at. By 2035, which is not that far away, Africa is going to have the world's largest working population. That in itself is either the greatest opportunity for consumer markets or the biggest risk to global uncertainty from a dystopian perspective. So I believe we're either part of the solution in ensuring Africa is the world's leading workforce, the world's largest consumer market, or we're all on the North Shore trying to get into Spain and Italy, which I don't think will be in great shape in 15 years. So I speak to investors pretty much 4 or 5 times a week, people identifying that Africa is the future from a talent perspective, but also from the consumer perspective. And really what we're talking about here today is greasing the wheels to enable that investment to come in and us to grow our talent and grow our businesses. So yes, it is difficult. Nobody ever said Africa was easy. You know, from Tanzania to Nigeria to Morocco to South Africa, there are challenges. But within this ecosystem, within this network, we are here to address those challenges and to make it easier. So I want everyone to kind of conclude this morning celebrating England defeating Germany for the first time in 55 years. And as a president of the British Chamber, I'm very proud to say that. I do have Irish colleagues in the chamber, but Ireland didn't qualify for the Euros. Sorry to throw that in there. But we are playing the Springboks this weekend, the British and Irish Lions, where we're looking for revenge from our World Cup defeat in 2019. One of my worst days ever in South Africa, I have to say. My sons didn't thank me for bringing them to this country to have to get all the bullying at school when we lost that. But hoping for a good series. Unfortunately, there will be no spectators in the stands, but we will be putting on some online events, hopefully with some of the players, so we can kind of share that sporting ethos and celebrate some British and South African excellence. We're in for a tough few weeks, and there's only one way, which is through. So please do lean on us at the Chamber if we can support. If you need help in terms of navigating the legal context, please reach out to us and we'll put you in touch with Bowmans. But please, I got a quote yesterday. It's a bit tough right now out there, so it pays to be kind. You don't want everyone's going through. So let's be kind to each other. Let's be optimistic, and let's not be afraid to ask for help. Onwards and upwards for England and the British Lions. And I wish you all a very good day and look forward to speaking to you in the next week. Thank you very much.